Hello, I am Rudy Rivera. To you and my friends all over the world, welcome to my YouTube channel, Conversations with Rudy Rivera. Please click subscribe and you will have access to many, many more interesting interviews with interesting guests on interesting topics. Don't forget, subscribe. I will see you later. You find ways to keep yourself busy. That's good. Fred, I want to welcome you to my program. We're looking forward to part 2. The last time we talked about how safe banks are. And that's why we continued the title to Too Boring to Fail. And now this is Too Boring to Fail part 2. And by the way, if you're listening on LinkedIn, don't forget to like. Also go to my YouTube channel, Conversations with Rudy Rivera. And subscribe, and just like anywhere you can find me, just do a like. So Fred, the topic tonight has to do with annuities. I've got annuities. Everyone talks about annuities, but can you give us a breakdown before we get into how safe they are, what they are and what they do? What's the purpose?
Sure, Rudy. Thanks, and good evening, everyone. When we did our last podcast, it was in the wake of the failure of Silicon Valley Bank and some other institutions that surprised a lot of people by ending up not being able to honor their deposits and being driven into the arms of the FDIC. Typically, that's something you think of in terms of a banking crisis. In the United States, we tend to think of insurance companies differently than banks, mainly, I think, in part because of the amount of advertising that insurance companies do to convince us how safe they are. Those of us who of a certain age will remember the ads about owning a piece of the rock and similar ads that tried to convince people that insurance companies were about the safest things around. So tonight we're going to talk about some changes in the financial situation of insurance and annuity companies and what that means for people who have purchased annuities and also what it means for some of the investors in those companies. And as Rudy said, and I'm going to share my screen here, it's important to think about it's important to think about this in terms of not only the way in which insurance companies operate, but also the way in which the insurance company treats the money that it receives from its policyholders. If you hold on just a minute here, we're going to go to our PowerPoint for tonight. It's often said that the difference between a life insurance contract and an annuity is that if you purchase a life insurance contract, the insurance company is making a bet that you're going to live. If you purchase an annuity, the insurance company is making a bet that you're going to die. And there is some truth in that. And that's why one of the reasons why you find the same company selling annuities and life insurance. But in the United States today, there are about $3 trillion, that's with a T, trillion dollars worth of annuities in force. And last year was a record year for annuity sales. Over $260 billion of annuities were sold in the U.S. With the increasing age of the population, that's likely to continue to go up, and also because of some other factors we'll talk about. So let's start out by talking about what exactly is an annuity. And here's a helpful definition. It's an insurance contract issued and distributed by financial institutions with the intention of paying out invested funds in a fixed income stream in the future. So what that means is that if you buy an annuity contract, number one, you're making an investment. Number two, you have an expected return of income over a period of time in the future. That's a very broad definition of annuities. Now, there are many different types of annuities, as we'll see here. Hold on just a second. Sorry, I lost the PowerPoint.
I can see you're proficient in PowerPoint.
I lost the PowerPoint. I have to sign back in. There we go. there are basically three types of annuities. A fixed annuity is the most plain vanilla. Basically, it pays out a rate based on a certain crediting percentage. We'll talk about that, what that means in a minute. So if you buy an annuity and the contract says that it'll credit whatever you invest in it at 5% a year, then when you get to the point where you start to receive your income, it'll be based on that. An indexed annuity pays based on some external index. A common index today is an equity index, such as the S&P 500, so that the value of the annuity will go up or down depending on that index. Typically, that'll be coupled with a guarantee that the amount that you will never lose your original investment. And then a variable annuity, which we're really not going to talk about too much tonight, is something completely different, where you have actual assets that you buy, stocks, bonds, mutual funds, in the annuity. And what you receive from the annuity company depends on the return of those assets.
But Fred, the huge difference between the life insurance and the annuity is the annuity, you can often pay just a big lump sum of money, and then the annuity company invests it, and then you get monthly payments. A friend of mine who's a lawyer did that with a big settlement. He put the money in and got a certain amount of money for 10 years or 5 years, whatever. I don't remember what it was. Where with life insurance policies, you pay the premium and it's every month, and it grows in value. Is that pretty much a fair distinction?
That's generally correct, although there is such a thing as single premium life, which is just what it says it is. You make one payment and you've fully paid the contract. However, the traditional way of purchasing a life insurance policy is with periodic payments. Most of the structure of life insurance policies in the United States is a function of the tax laws, so that in general, the buildup inside your life insurance contract is not taxed, and the life insurance benefit, when you paid out to your survivors, is not taxed. Those benefits are what drive the purchase of life insurance. But in exchange for that, there are restrictions on how much you can pay into a life insurance contract and still enjoy those tax advantages. Whereas with annuities, there really aren't any restrictions. The key to understanding annuities is to understand that there's a point at which the accumulation phase, as shown here, stops. That's the point at which you are either paying in or you are earning credits on what you've paid in. And the distribution and depletion phase. Now, that second phase begins when the contract annuitizes. What that means is either you elect to annuitize at a certain time, or the contract provides a date at which you annuitize. And at that point, you no longer receive credit for what you've invested, but you start to pay out, but the company starts to pay out the income stream. And typically, that income stream will pay until you die. There are annuities that pay out for a term certain. In other words, it pays out income for 10 years, 20 years, but those are not nearly as popular as a traditional annuity that pays out until death. And the reason is annuities are a popular retirement planning tool. People like the idea of being guaranteed a certain fixed amount of income for the rest of their lives. A couple of other points to make on this chart. You see that in the accumulation phase, as the surrender value grows, the surrender penalty decreases. And that's an important thing to remember about annuities, that when you buy an annuity, the contract provides that if you take the money out before you annuitize the contract, then you owe a surrender penalty to the company. And the reason for that is that the company's finances depend on investing this money for a long period of time. And if you take it out early, then they're likely to suffer a loss. So to protect themselves, they charge you a surrender penalty. And as the contract increases in value, the surrender penalty goes down because there's less of an impact on the company's finances. Also, most annuities today come with a death benefit rider that provides that if you die before the contract annuitizes, you will receive back usually whatever the cash value of the annuity is at that time. And that's to prevent the scenario where you've paid in for a long period of time and die and then end up getting nothing at all. But as you can see, once you start to receive income from the annuity, the death benefit decreases rapidly. So that, in very broad terms, is how annuities work.
Well, let's talk about, now that they know how it works, what's the risk? I mean, most
Well,
people perceive annuities as being a safer bet. The investments are safe, but my prior conversations with you tell me no, it's not as safe as people think it is.
well, let's look at how a typical annuity works. This particular example is for an indexed annuity, but it works for a fixed annuity as well. Start up in the upper left hand, or as you see it, I guess the right hand corner, where it says client premium and accrued interest. So the client pays a premium into the contract. That amount starts to earn interest. And then the insurance company then invests that money. And in this case, hypothetical, it generates a 5% return. So the money is in what's called the general account of the insurance company, which means that the insurance company takes all the money it receives well, not all the money, but in money it receives as premiums and invests it in one big account, which they invest in various investments. We're going to talk about that later. Then you can see the company takes a cut for its own profit and for the expense of running the company, in this case, 2%. 5% from 2% is 3%. So if it was a fixed annuity, they would simply deduct the 2% in profit and expense from the 5% they owned on their investment, they made on their investment. That generates 3%, and it would credit 3% to the account. And then it starts over. An indexed annuity works a little bit differently because, remember, the company is guaranteeing you a return based on a certain index. So what the company does is, an index is typically a way to track the price of a large number of different securities at once. The S&P 500 index is a good example. But the company doesn't go out and buy all 500 securities. Instead, it buys an index option. So in other words, it buys an option that will track the value of the stocks in the index. It's a call option, so it gives the company the right to buy those stocks at a fixed price, and of course at a certain price. And of course that right has a value, and it can be bought and sold. And so the company then takes the money that it's made on the option, and the option rises in value as the S&P 500 rises, and credits that to the client.
Fred, you locked up on me. Are you still there? Fred, I hope you come back. There you are, Fred. You have to unmute yourself. Fred, you're still on mute.
I don't have any idea what happened there. It simply kicked itself out of the PowerPoint. There we go. So that's an overall explanation of how annuities work. And over the years, annuities has been thought of as sleepy investments that had essentially no risk, but also not a great upside return. It was something you bought if you wanted to be absolutely sure of a particular stream of income in retirement. In recent years,
nothing is sure, Fred. That's the problem. Nothing is for sure.
Well, and in recent years, it's become less sure. And there have been a number of articles written lately about the fact that many big life insurance and annuity companies have changed their investment philosophies, in large part because of large investments by private equity. And this article from The Economist last week discusses this. Traditionally, life insurance and annuity companies were either publicly held or they were mutuals in which the shareholders were actually the policyholders. And so they were either widows and orphan stocks that paid high dividends and nobody really paid much attention to the return on equity on, or they were mutual, in which case all the profits went to the policyholders. Well, that's all changed now because there's been this big stampede of private equity money into insurance companies. And when I say big, I mean big. One of the things that people fail to realize in the US is that these insurance companies life and annuity companies are enormous. Here is a list of, as of this actually is a couple years old, so these figures are even higher. But here is a list of the largest insurance companies by asset size. And as you can see on this, there are two over $1 trillion and many others that are well over $500 billion. So these are big, big companies, and they have millions of policyholders. And a change in the way these companies invest their money can have a big effect on a financial system. And
But
so let's
Fred,
talk.
well,
Yes.
what is the risk though? I mean, why is it all of a sudden riskier?
So in the old days, life insurance companies and annuity companies would invest would invest in assets whose maturities mainly tracked the maturities of their liabilities. In other words, they knew from actuaries and from experience exactly when they would have to pay off on these life insurance and annuity contracts. And so they could take very long-term conservative investments and use them as and be certain that they would have the money to pay off their liabilities, their policyholders, and have something left over. And that's why traditionally in the old days, what's the big investment that you think of associated with life insurance companies? It's giant office buildings, right? Remember the Transamerica Tower it's one of the symbols of San Francisco? Or how about the John Hancock Tower, the symbol of Chicago? And all of us have seen many buildings with the Prudential logo on them. They built them all over the country. Now, why did life insurance and annuity companies like those as investments? Well, first of all, they were big. Secondly, they put out a steady, dependable flow of cash from large tenants. And third, over time, they could generate capital gains. If they held the building for 25 or 30 years and fully depreciated, you could get a significant capital gain. And they would time that with the obligations that they had under their policies. And so it was a very safe way to make money. However, all that has changed because of the allure of something called the collateralized debt obligation, the CDO. And this is one of these Wall Street miracles that takes obligations that are not AAA rated and do not have the highest credit rating and turns them into a AAA rating. And you can see here as we go from one side to the other, what the Wall Street banks will do is they will take combinations of loans, car loans, commercial loans, mortgage loans, and they will create this collateralized debt obligation, which is a security that is made up of many, many slices of these loans. And they will be senior slices, what's called mezzanine slices, and equity slices. And each of these tranches, as they're called, has a certain amount of risk associated with it.
Well,
So the
Fred,
senior
let me just stop you here for a second, because this is similar to what happened in the securitized mortgage market.
right,
A,
that's
a lot
exactly
of,
that's exactly right.
right. A lot of loans were sold into big portfolios. And I think in many ways, the rating companies may have bordered on being dishonest in saying this is a AAA rating when it's really a C or a D rating. So they were selling these portfolios where people believed were AAA rated, and they actually weren't. They were buying riskier mortgages.
Well, these securities are sliced up so that you have some at the top level that are rated AAA, some in the mezzanine area that are lower rated, and then the equity portion is the lowest rated, and that's typically held by the investment bank or the sponsor of the securitization. Now, who buys these? You can see at the end here, the investors are listed as hedge funds, insurance companies, and sovereign funds. And that's generally true. But if we look at the way these things work, the way they work today is you have a manager who is managing a portfolio, and he or she has this collateralized loan obligation, or special purpose vehicle, as it's called, that's whacked up into all these tranches. The top tranche is AAA, the bottom tranche is equity, which is unrated. And they sell these to investors. Investors receive principal and interest. Anything that's left over goes to the equity. That all sounds uh, that all sounds great, but as we'll talk about later, this is significantly riskier than the way life insurance companies and annuities companies used to invest.
Well,
What's happened is that
Fred,
these CLOs. Go ahead.
mostly they've used real estate as the investment tool. I mean, all they form what's called real estate investment trust. They may buy in, say Prudential may buy in with somebody else, buy huge shopping centers across the country, and that overall was considered to be a safe investment until I guess the real estate market tanked. But
Well, not only that, but this is all about chasing yield. Today, many REITs, actually, their primary asset are not the land itself, but mortgages. And the mortgage is then whacked up. It's either syndicated or it's made part of one of these CLOs so that you can get a much higher yield on it than you would if you were simply holding the property. And these vehicles, these CLOs, are not new. They've been around for a long time. What's new is the interest of life insurance companies in them, because before the great financial crisis in 2008, most of these CLOs were bought by banks. But since then, since the Dodd-Frank Act and the capital restrictions on banks, the amount of capital that banks have to hold against something like a CLO has become prohibitively high. So banks aren't interested in them anymore. So they have found a new market for them in life insurance companies. And what's happened is the purchase of life insurance annuity companies as CLOs since the Great Recession has absolutely skyrocketed. Here's a slide from the Federal Reserve that shows since 2010 the increase, and you can see that the amount of these CLOs that have been added to insurer general account investments. And remember, those are the investment accounts that we talked about earlier that determine rate on its annuities, have skyrocketed. It was below 25 billion in 2010. Today, it's 10 times that. So this has become a much larger portion of the investments that life insurance companies and annuity companies are making. So that's the one big change in all of this. The other big change is that as I mentioned earlier, the private equity financiers have discovered life insurance and annuity companies. And so what they have done is they have gotten rid of or reduced the traditional older investments, style investments, the office buildings, the mortgages, long-term loans, and replaced them in large part with these CLOs. And the reason they've been able to do this is that insurance companies and annuity companies are regulated in this country completely differently than banks, which, as I mentioned earlier,
yeah, I was going to get to that. What's the big difference in how they're regulated?
Well, this goes back to a statute that Congress passed about 100 years ago called the McCarran-Ferguson Act, which says, and this may be hard to believe, but this statute says that the business of insurance is not interstate commerce, and therefore Congress cannot regulate it. And so insurance in the United, because of that statute, insurance in the United States is regulated by the states. And what that means is that every state that an insurance company operates in has its own insurance department, and the insurance company has to deal with them on a state-by-state basis. Now, in the state where the insurance company is located, traditionally that's the state that keeps an eye on things like capital levels and investments. But you're talking about resources of state insurance departments versus the federal government. So you have a much lighter touch on regulations. Also, you have very different rules from state to state. You have what's called regulatory arbitrage, where companies will move from one state to another. For example, there's a reason, if you've ever been to Des Moines, Iowa, why the entire skyline of Des Moines is nothing but insurance companies. Insurance companies like Iowa, because the regulations are relatively lax, and so many of them are in Iowa. That's just one example. But what's happened is that these insurance company capital requirements require them to hold much less capital against something like a CLO, collateralized loan obligation, than a bank would. And that means, number one, it's a more attractive yield. It's a more attractive investment for the insurance company. But number two, it's a riskier investment for the insurance company. Because
Why
if
is it
something goes,
riskier? Why is it riskier? Because I can understand the risk of having a run on a bank. Everyone says, give me my money. Okay. Like, It's a Wonderful Life with um, James Stewart, and they
yes.
go to the bank and you had to have $2 left. But why is it? I mean, why is that? You can't have a run on an annuity unless you have people cashing in on their annuities.
So let's talk about that. The all life insurance and annuity companies monitor very carefully what's called the surrender rate, which is the rate by which people withdraw from their contracts, or the other related phenomenon is called the lapse rate, where people just stop paying into the contract. And surrender rates are a significant concern for annuity companies because surrender charges are in part dictated by what the annuity company thinks they need to protect themselves from a premature surrender, but they're also dictated to some extent by the market. So that if other insurance annuity companies are offering lower surrender charges, companies will have to lower theirs in order to compete. And the big driver of surrenders of annuities is interest rates. So if you have a period where you have, as we have had in this country, very low interest rates followed by a sharp increase in rates, you can have a scenario where people suddenly start to withdraw, suddenly start to surrender their annuities so they can go invest at a higher rate. Similarly, if there's a big run up in the stock market, people may decide to surrender their annuities, pay the surrender charge, and go seek a higher return in the market. And in periods of extreme volatility, where you have big increases in interest rates like we just did, or big changes in the stock market like we're having right now, there is some risk that there will be a large number of surrenders. Now, what protects the policyholder in that scenario is the insurance company is supposed to hold enough capital to protect itself against a wave of surrenders. And in this country, for the most part, that has worked. Also, we have what's called a guarantee scheme in this country where every state has a guarantee fund that all insurers pay into, so that if an insurer went broke, the guarantee fund would be able to pay out on the insolvent insurer's obligations. However, those funds come with a lot of restrictions. There's typically a maximum benefit that you can get under them, and they've never really had to withstand the failure of an extremely large company, which they probably wouldn't be able to withstand.
Well, I know a regional title company in Houston that went into receivership. And so I had experience with the Guarantee Association going in and contributing on some of the losses, but it's never 100 cents on the dollar.
No, it's never 100 cents on the dollar. It takes a long time. Insurance insolvency proceedings do not go through the federal bankruptcy courts. They're all state-based proceedings, and they can go on for 10 or 15 years. You can be waiting a long time to get your money. But to get back to your question about whether or not people should be worried about waves of surrenders, it has happened. A few years ago, there was a Italian annuity company that failed because of a wave of surrenders caused by a number of factors. And that was kind of a wake-up call to a lot of regulators who started looking at some of these at some of these investment schemes. Because the other side of this C is that these CLOs are not very liquid. I mean,
What are CLOs, Fred?
That's the collateralized loan obligation that we had up on the slides before. Generally, if you sell them before maturity, you're going to take a big markdown. And that is what insurance. So the insurance company wants to avoid a liquidity problem by having enough cash on hand to pay claims and without having to sell these instruments like these CLOs, which they will hang on to for the long term. Now, the problem with that is that what many of these companies have done, particularly since they've been purchased by private equity, is that they have started to use short-term financing, like commercial paper, to support the purchase of these long-term CLOs so that they don't have to sell the CLOs to pay claims. They can continue to maintain the high yields on the CLOs and roll over their short-term funding. Now, if
But
this sounds,
that brings more risk though, right?
yes, yes,
Okay.
that's what's called maturity transformation. That's taking short-term obligations and using them to achieve a long-term yield. And if all that sounds familiar, well, that's a lot like what happened during the
With
financial crisis, where you had companies that had large holdings of mortgage-backed securities that they were financing by short-term obligations. And if you remember what happened there, you had all these defaults in the subprime loan area, which caused people to start the value of these mortgage-backed securities to start falling. People started panicking. They started trying to sell them. They couldn't sell them. They tried to sell more short-term paper. And finally, it got to the point where a couple of big companies could no longer roll over their short-term paper, and the government had to step in. So the question on the regulators' minds is this could we see this scenario again for life insurance and annuity companies? And the answer is maybe. CLOs their performance is tied in large part to the overall economy. If we had a significant recession and people started having difficulty paying their mortgages and their car loans, and if large companies that had borrowed money that were the subject of these CLOs started to file for bankruptcy, then you would start to see some of these CLOs start to get into trouble. And the place that they would get into trouble first would be in what's called the mezzanine tranche. So we looked at a minute ago. That's not the AAA tranche. That's the tranche that in exchange for a higher yield, you take more credit risk. Now,
well, Fred, is that for our listeners, when you talk about mezzanine, you talk about mezzanine financing where they're investing in that?
Yes. In other words, if you look at the tranches that we saw on the slide before, you had the top tranche, which is the AAA rated tranche, and the bottom tranche is the equity, which is the residual risk that the sponsor holds, and in between is the mezzanine, and that's the stuff that's not AAA but not junk either, and it pays a higher rate, but it's more exposed to credit risk than the AAA stuff is.
Well, and for our listeners, though, mezzanine financing is, correct me if I'm wrong, Fred, it's you own a building and you borrow the max, right? But you need more money. So then you borrow the difference, beyond what the bank will loan you. That's what I understand mezzanine financing to be.
Well, that's a direct loan in real estate finance, yes. But the mezzanine level, it's a common term used in finance to describe a layer between equity, which basically is the residual risk in whatever the deal is, and the senior debt, which gets paid first. This is the stuff that gets paid somewhere in the middle, and they get a higher rate for it, but they take more risk.
But why is mezzanine a higher risk?
Because there's a higher risk of default. So in other words, the way these things are structured, and this gets into more technical aspects of it now, think of this giant pile of loans, okay? And every month a check comes in from all these borrowers. And so you've got all this money. And then there's this complicated formula by which you create what's called a payment waterfall. And you say, okay, assuming let's say we get 100% of the payments every month, well, then everybody gets paid, so it's not a big deal. But let's say we only get 90% of the payments every month. Well, what that may mean is the AAA tranche will still get paid at 100%, but now the mezzanine people will only have to take, I don't know, make up a number, 75%. And the equity won't get anything because there's not enough left over. And as defaults increase, and you only get 75% of what you expect each month, or 60%, and then some loans default altogether, so the principal starts to decrease. There's this complicated formula called the waterfall that parses out who gets what through the different layers. And the mezzanine people, while things are going well, they get paid at a higher rate, but they get cut off earlier than the senior debt.
What I find interesting, Fred, is that banks that are federally regulated more likely to go out of business and have gone out of business as opposed to these insurance companies that are regulated by state.
Yeah, well, let's be clear. The failures we talked about last time were not because of credit risk. It was because of mismanagement of interest rate risk. As we talked about before, they invested in low yielding bonds. The value of the bonds went down. When interest rates went up, people took out the deposits. They couldn't sell the bonds fast enough. And so they had a liquidity crunch. That's not what we're talking about here. What would have to happen here is you would have to have some general economic downturn that led to a significant deterioration in the credit quality of the obligations underlying these CLOs. And if that happened, then the question would be, as these things started to get marked down, could you have systemic risk? One of the other factors we haven't talked about here is that these private equity guys like these things so much, is that they've set up affiliates to these insurers who are sponsoring the CLOs. So in other words, you not only have now the insurance companies investing in either the senior or the mezzanine tranches, but they have affiliates who are sponsoring these deals, and they're taking part of the equity too. So that because the potential in the equity is for even more return, but there's greater risk. So they're taking more and more of this stuff on. And the problem would be, in a downturn, then the insurer would not only be exposed to defaults on the debt, but they would be exposed to defaults. They would be exposed to loss of their equity in their affiliates. And so that, just as the return is ramped up on the upside, the risk is ramped up on the downside. And we've seen this story before.
Well, Fred, we spent 37 minutes talking about what the risk is, but I have annuities. Other people have annuities. What do we need to do? And what can we do to protect ourselves?
Well, first of all, much like our last conversation about the banks, I don't want to be a Cassandra who's telling everybody that their insurance company is going to fail tomorrow. As I mentioned before, these are gigantic companies, among the largest financial institutions in the world. They have significant assets. None of the big companies certainly are going anywhere anytime soon. But the problem is you have the potential of this systemic risk, and that once things get started, as we found out in 2008, it's very hard to stop. So as a policyholder right now, what can you do? The answer is really not much. As most people probably know, there are ratings of insurance companies. The best known ones are called AM Best. They are very dependable in terms of rating insurance companies on the basis of their ability to pay claims and honor their contracts, but they are not always correct. For example, many people will remember that one of the things that touched off the financial crisis in 2008 was the near failure of AIG, which was considered a blue chip insurance company. The day that the federal government announced a bailout of AIG, AM Best's rating of them was A++, the highest rating. So insurance company ratings are a guide, but they're not a guarantee.
Well, but don't you think people should at least take into account in whatever annuities they have, where that money's being invested, and ask questions? Because I think most people just put it in the drawer. It's going to pay me a bunch of money. You think it's worthwhile looking at them and talking to the person that sold you the annuity? Hey,
well, I was going to say, it's the average person. You can tell just from the explanation time, and we're just really skimming the surface here. This is very complicated.
Oh no, you got my head spinning circles, Fred. Okay, good.
So you could tell somebody, well, yeah, sure, go look at the financial statements of your insurance company, and you wouldn't be able to. Most people would have a very difficult time interpreting them. But you hit the nail on the head. The first thing to do is to go talk to the agent who sold it to you and say, hey, what is the claims paying ability of this company? What is their AM Best rating? And the other thing is, have they made any recent significant changes in their investment portfolio and practices? And then I would also ask, how exposed are they to these exotic instruments like collateralized loan obligations and what have you? Because, many big life insurance and annuity companies are still heavily invested in the traditional instruments that they've always been invested in, which is real estate mortgages, long-term corporate bonds, very safe long-term obligations. But many have taken a different tack. Like another thing we haven't talked about tonight is on the life insurance side, many private equity companies who have gained control of these insurers have set up offshore reinsurers, which Rudy, I know you've dealt with, many of whom are in Bermuda, and they depend on the ability of the reinsurer. Reinsurance is basically just insurance for insurance companies. Reinsurer to pay the claim, so that and the regulator will generally allow them to do that, which frees up more of their capital to invest in other stuff. But it also puts more emphasis on the ability of this reinsurer to pay. So another question is, how dependent are they on a reinsurer, and how solvent is a reinsurer?
Well, that's a double-edged sword, because if you look at a company that's got small reserves, for example, and they're going to have reinsurance, but oftentimes that reinsurance only covers one or two catastrophes, or may not cover everything. So I think you need to look at, does the company have sufficient asset reserves to cover most claims? And the event of a catastrophic loss, is there reinsurance to back it up? And it's not just generally one reinsurer. It's basically a tower of companies that split the risk, which is what Lloyd's of London is all about.
Yes, well, I mean, we could do a whole other presentation on reinsurance.
On towers and reinsurance. Oh, yeah.
It's fantastically complicated, but I think the main point here is this is another device that private equity is using to reduce the capital that's in the company that's devoted to paying claims, and deploy more capital to investments that will increase yield and provide a larger profit for the shareholders of the company. Now, to be clear, many of these companies have seen big gains in their stock prices since being purchased by or getting investments from private equity. And that in itself is a good thing for the company, because in case it needs to raise more capital, it can do so at a higher price. But there again, that's a double-edged sword, because an insurance company comes out and says, well, we're going to sell more stock because we need more capital, could spook people. That's what happened to Silicon Valley Bank. What set off the run on Silicon Valley Bank was their announcement that they were going to sell more stock to raise capital, which was probably the right thing to do, except that it hit the market the wrong way. See, the great uncertainty here is just how much it would take to tip this thing. I mean, it's pretty clear that you wouldn't need massive defaults in these CLOs for the market to start to get nervous about the fact that that some of these companies are very exposed to them. It just takes a little push in the wrong direction. And then once that starts, then the first thing that happens is people start getting nervous about buying these same companies' short-term paper. And then if that happens, they can't operate. So it's something that we saw with Silicon Valley Bank and First Republic recently. It can happen very fast. And that's what I think the regulators are concerned about. And maybe we should talk a little bit about that. Because of the state regulation of insurance companies, it's very difficult to get an overall picture of what all of them are doing at the same time and what their overall financial position is. Whereas that's not true with banks, because you have federal regulators who, and also because the banking has become so concentrated in this country that the big federal regulators have a pretty good idea of the capital position of all the big banks. You can't really say that about insurance regulators, because there's 51 of them. You get 50 states and the District of Columbia. So there is an organization called the National Association of Insurance Commissioners, the NAIC, that traditionally has cooperated on things like this. And they have recently come out with guidelines on what state regulators should be looking for when they examine these companies and look at the CLOs in their investment portfolios. But they're really just starting to wake up to this. One of the things I mentioned in my newsletter article on this is that Dodd-Frank The Dodd-Frank statute does have a provision that allows a federal agency to designate a non-bank as a systemic risk. And in that if they did, they would be subject to prudential regulation by the Federal Reserve. In other words, if the Federal Reserve would come in and look at their capital and examine them and determine if their capital was sufficient. And after
Fred, what's the Dodd-Frank Act for people who don't know?
Dodd-Frank was the federal statute that was passed in 2010 that really tightened up federal regulation of banks, required banks to hold much more capital, created the Consumer Financial Protection Bureau, made a lot of other big changes in the way banks are regulated. But there is a provision in that statute that would allow the Federal Reserve to do that. And after the statute was passed, they did designate two companies, or rather three large life insurance companies, as potential systemic risks: MetLife, AIG, and Prudential. Well, MetLife sued the government and won and got the designation lifted. And after that, the government gave up on trying to designate Prudential and AIG. So as of today, there are no companies in that under that. It has not been successful. Now, recently, the feds came out and said they had changed the guidelines on that, and we're going to take another look at some of those companies. So we could see that happening again. But the concern is, if one of these really big companies, like a Met or a Pru or an AIG, started to get into trouble, that you could rapidly have a big waterfall effect that could have an effect on the whole system.
Fred, this is all so very technical. You've given us a lot of information. What I like to do in these interviews is give our listeners maybe three takeaways from this. What are the three things they should remember from our conversation here together?
Well, the first one is, as you and I have talked about before, there's no such thing as a risk-free investment. Annuities, even though they're advertised as safe and secure, there are risks associated with them, and you need to carefully consider the risk you're taking. And the biggest risk generally is the underlying financial stability of the company you're buying it from. So that's number one. Number two is, don't put 100% of your trust in your insurance agent. And I hate to say that, but annuities are notorious as products that are sold with very high commissions. They are very profitable for the agent. So the agent is greatly incentivized to sell you an annuity as opposed to another investment product. So you always want to make sure, and these days, of course, insurance agents sell all sorts of other things too, that the insurance agent, number one, understands your objectives, and number two, has presented you with a series of alternatives. In other words, well, if you want income in the future, yes, you could buy an annuity, but you could also buy, some mutual funds, or you could buy, a diversified portfolio of stocks, or you could buy some other things. And you need to make comparisons among those different strategies, as opposed to saying, hey, here's a product, you're going to get this income for the rest of your life. You don't have anything to worry about, because no matter what you buy, you do have something to worry about.
Fred, almost everybody I've ever seen or who's ever talked to me who claims to be a financial planner is really a glorified insurance salesman. The only person I've known or people I've known who are not just insurance salespeople are people who don't work on commissions. They work based on the assets you have. And even then, I'm sure there's some dark secrets with them.
Well, see, this is the problem. If you work with a financial planner who is being compensated, who, number one, is not selling you the product. He's buying the product, you're buying the product from somebody else. And number two, is compensated on a basis other than the sale of the product. Then that removes some of the conflicts of interest. But you're right, you can't completely remove them, and that's a candid conversation you need to have with your advisor, saying, hey, what's in this for you? What are the conflicts? What should I be thinking of on my own? Because to your point, many of these people, while they claim to be advisors or fiduciary, I don't like to call themselves fiduciaries, but to have your best interests in mind, the reality is, they're trying to make a buck. There's nothing wrong with trying to make a buck, but you have to understand what their incentives are. And then the third thing I would say, since you asked for three, is pay attention to what's going on in the financial world. because things can happen very fast. I mean, look at Silicon Valley Bank. That went from being a high riding, very desirable investment in bank to broke in 2 weeks. And, it was shocking. And the problem today is with so much money moving on the internet and so much news moving on the internet instantly, things can happen really fast. So pay attention to what's going on, especially if you have if you have a large investment in a particular company or companies. Try to keep up on the news about those companies because things can happen quickly. So those would be my 3 takeaways.
I think just to be devil's advocate with you, Fred, I think that, or to just present a different twist, it's hard to trust anything. That's the main point. And the one takeaway I would give to people is use your common sense. Does this really make sense? When they start promising you really high returns on investment, or that it's a safe thing, the safest thing you're going to get, then run far away.
Right.
Because none of it is safe.
Right. If someone comes to you and says, "Hey, I got this deal here. It's going to pay you 9% a year for the next 10 years, guaranteed."
Run.
First question's got to be, how come Warren Buffett didn't buy it all?
Exactly. That's the issue. I had a client years ago, a retired police officer who invested in what they call viatical trust. Remember those?
We could do a whole other thing on viatical settlements of life insurance policies, which are one of the most fraud-ridden things out there.
Oh, exactly. You people with AIDS, before there was a cure for AIDS, would sell their life insurance policies, and these companies would get investors, and you never knew when the person was going to die. And then with all these medical advances with HIV, they're not dying, and you don't know who the other investors are. It was just terrible.
Yeah, there were these things called wet viaticals. You know what a wet viatical is?
No,
a wet viatical, it means that the ink on the application for the life insurance policy is still wet when you're making a viatical settlement and selling the policy to somebody else. And insurers try to monitor those. But yes, that's another area that involves a tremendous amount of fraud. But I mean, to your point, unfortunately, I guess if you have a truly trusted advisor that you have had a long relationship with, or somebody else has had a long relationship with, that is a very, very valuable thing, but it's very, very hard to find.
It is hard to find because these agents are often acting in their own interest. You're right. The life insurance policy. So life insurance get big commissions up front, but they phase out. A property casualty guy gets commissions the whole time that you've got the policy.
Right.
So they build book of businesses differently.
Yes. Well, and see, this is the thing. The developments we're talking about here today are just the latest in a whole long saga of what's called disintermediation, as money that in the old days was all in life insurance and annuities. I mean, you and I are old enough to remember when it was the idea of an individual person investing in the stock market. That was a pretty exotic thing. I mean, it was, there were fixed commissions. You really didn't know how to do it. You had to page through the paper to find out what the stock was worth. It was much easier to just, talk to your life insurance salesman who had sold your grandfather a policy and put the money in that. Well, over the years, all that money has come out of the life insurance annuities companies and out of the banks who, are selling CDs into a million other different things. And all these disruptions that we're talking about are just part of that phenomenon. And it's going to continue.
I know. It was a long time ago when the 12 apostles and I were sitting at the table and we were talking where to buy annuities. I was there with Moses talking about the annuities too. At its infancy stage, right?
Well, the company that sold Moses an annuity probably didn't do very well because didn't he live till he was like 1,000 years old or something?
Right. So they lost money on him. Yeah, exactly.
That was a bad deal.
Fred, in closing, how can people reach you? You are an expert witness. You are a AAA arbitrator.
Yeah, the best way to get a hold of me is at my email, which is just fred@egler, egler.com, fred@egler.com.
Well, to my LinkedIn audience, thank you very much for attending. I know this was a
Oh,
very
Rudy, if I can interrupt you, so that reminded me, you mentioned LinkedIn. I do have a newsletter on LinkedIn, which I put out about once a month. So if you're on LinkedIn, please look me up and subscribe to my newsletter. It's called the name of the newsletter is Managing Risk.
Well, everyone subscribe. I know this was a very technical conversation, but I think the point we want, yeah, very technical, Fred. I think the point we want to get across is don't assume that anything is safe. Always look to what the risk is involved and then use your common sense and don't get greedy. I mean, those are the great takeaways, right? So thanks
I would
again,
agree.
Fred. Thank you to my audience on LinkedIn. We're going to stop the live stream now. And to my audience on Zoom, thank you so much for showing up, and we'll see you the next time. And Fred, one time we're going to have to do one on cryptocurrency because I still don't
Oh,
understand that. And so,
okay. That would be
okay,
fun. That would be fun.
sounds good. Thank you, Fred. I appreciate it. Goodbye.
Thanks. Good night.